Jose, for some reason, the connection dropped, so I'm going to need you to give me access again, please.
Okay. Whenever I see the sign, I'm going to approve.
Perfect. Good morning, everyone. Can everyone hear me okay? So it's 9 o'clock. Welcome to the pre-qualifying for a loan webinar hosted by the Orange County SBDC in partnership with East West Bank. Thank you for being here on time. We're gonna go ahead and get started, and please make sure that you familiarize yourself with the features of Zoom. If you don't know how to use it, you hover over the screen, and if you hover towards the bottom of the screen, a menu should pop up that will give you access to the chat box that you should be using to ask us any questions, and I'm going to give you more details on that. Okay, so for those of you who aren't very familiar with us and with what we do at the Orange County SBDC, we have helped stimulate economic growth in Orange County since 1991. We have provided small business owners and entrepreneurs with no-cost consulting services and a wide variety of training opportunities, in addition to access to extensive network of resources. Every year, we have worked very hard to assist more than thousands of clients, and we provide, by providing business workshops to thousands of attendees across Orange County. We are partially funded by the SBA, the Small Business Administration, and we are hosted by Rancho Santiago Community College District that is located in Santa Ana, right off the 5 freeway and Main Broadway. If you're not one of our clients yet, I'm going to provide you with additional information in case you decided you need additional assistance after this workshop. What we do, as I mentioned, is we offer no-cost business consulting to help you start, expand, and grow your business for online and retail. We also help you with your marketing, with your access to finance, any accounting, international trade, and general business needs as well. Our team at the Orange County SBDC is a very diversified team of consultants, and we basically work with you one-on-one through your business needs to assist you with what you're looking for. If you would like to be added to our mailing list, make sure that you text OCSBDC to the number 22828, and I'm going to go ahead and send that in the text box so you can make note of it, and then you're going to be added to our list, and you will be receiving any updates for your email to join our mailing list. Also, make a note that we are on Facebook, and we do share tons of articles and events and workshops that is very applicable and that is very helpful for the small business community, be it startup or if you are in business. So make sure you check us out at www.facebook.com/OCSBDC. I'm going to go ahead and send the link in the chat box as well. I'm going to also provide you with our phone number and our website in the chat box in case you would like to learn more about us or our upcoming workshops, or in case you would like to call and request assistance. Our phone number is 714-564-5200, and our website is www.orangecountysbdc.org. Just to give you a quick background about myself, my name is Manal, and I've been with the Orange County SBDC for 8 years now. My specialty is the online world, so I do work with small business owners to help them get started through e-commerce presence or to expand their physical presence through online. I also do help small business owners who need access to microloans, and my specialty is the digital marketing world. So if you have any questions and you would like to ask me direct questions after this session, please feel free to reach out to us and be more than happy to help you. So before we, I proceed to introducing our speaker, the reason we are all here today, I want to make sure that all of you were able to locate the chat feature. So once again, make sure that you hover on top of your screen and then go towards the bottom. A menu should pop up, and that's where the chat box is located. If you cannot see it, again, make sure that you hover towards the bottom of the screen. And once the menu pop up, you'll be able to locate the chat icon. When addressing your questions, make sure that you do select next to the 2 from the drop-down window, all panelists and attendees, so everyone can see your questions. And then this way, once Jose is completed and is done with his presentation, we're going to go ahead and answer all of your questions, and we're going to do our best to make sure to address all the questions. Now, if you would like to request an appointment and to be contacted right after this webinar to schedule you for a free, no-cost one-on-one consultation, please send a direct message only to all panelists, not to everyone. Make sure you include your name, email, and phone number. Otherwise, what we're going to do is we're going to be using your contact information you used to register for this webinar in order to contact you to schedule you for an appointment. There are 2 things I would like to bring to your attention. We're recording this webinar. So at the end of this webinar, you're going to be receiving a link to the recording so you can review it at your convenience. Also, after this webinar, expect to receive an email with a link to the survey. We would be looking forward to your feedback. So on to the reason why we are all here. I would like to welcome our presenter, Jose Juan Vega, who is the first vice president and manager at East West Bank. I've known Jose for about 2 years now, Jose? Maybe a little bit more a year. And I've worked with his team closely through assisting our clients obtaining some access to capital. And I'm really looking forward to his presentation and to all the nuggets that he's going to be sharing with you today. Jose, it's all yours.
All right, thank you very much. Good morning, everybody. Manal was indicating that the purpose of the presentation or the discussion today is about access to capital. And that topic is very extensive. And my purpose today is to share with you from my personal professional experience, the big picture on the opportunities that there is for access to capital. In regard to myself, I've been in this industry for almost 20 years. I studied as a consultant with the SBDC, and the similar role as Manal has. I've been part also of programs as a consultant such as Goldman Sachs 10,000 Small Business, and also most of my career working with banks on the business banking unit in different roles, different aspects, all the way from putting in a loan application, preparing a business plan, all the way to processing, closing, funding, and then liquidating loans that do not perform. So I had the opportunity to have the full rounded experience in the full lending cycle. So again, what I'm trying to do today is to present kind of a big picture strategy as of how to consider financing for the small businesses. And what I like to do is to start talking in regards to financing for an existing business. And the reason is, if anybody that open a business today the legal definition of an existing business is when you have a business license and your fictitious business name and your checking account. Those three elements, that's what legally creates your business. So if Jose opens a business today and I got my business license, 1 year from today, I can claim that I have a business that is 1 year in business from the legal perspective. Also, the opportunities business are much greater than the startups. So if anybody decides to start a business today, in one year from today, there will be more opportunities. So I've seen business owners, entrepreneurs, that they decided to start their business at a small level. Once they get some traction, then they start exploring for different opportunities on financing. And so my point is, anybody can become a business owner today if they choose to do so. And then in 12 months from now, there will be an existing business. And then at the end of my presentation, also, I'm going to talk a little bit about how to obtain financing if you really wanted to get financing from the beginning as a startup. All right? Well, let me start with it. In general, for an existing business, normally most banks, they will ask for business financial statements. The most important document will be income taxes. So I'm not going to go to this checklist. Any lender can provide it to you. I think the most relevant is what a lender does with the information. Once you provide the application, all your personal financial statements or your personal income taxes, business, this information is provided to a financial analyst. This analyst has to make a responsible recommendation as to which loan application should be approved or declined. What is important to note is many times these underwriters, they have no experience on managing small businesses, or they have no experience on the industries of the businesses that they're applying for. For example, this morning, today, we might receive 3 loan applications, one for a beauty salon, auto repair shop, and a gas station. The underwriter has to go through the information, and he will be able to, he will have to express a professional recommendation to the bank as to which application should be approved. So the question is, how is it that somebody who has no experience of any business or any industry can really make that responsible recommendation? So what in lending, what the underwriter or underwriting, they do is that they look at 2 aspects of the application. Number one is creditworthiness. Is the applicant somebody that is subject to credit? Can the applicant, the business applicant, be considered for credit? And the second is the capacity to repay. Now, capacity to repay has to do more with the loan amount and whether the business is in a position to repay the debt. So I'm going to explain this to a little bit more. On creditworthiness for small businesses or being subject to credit, it's the evaluation of the people's credit report or the business owners, what the personal credit report is, the management experience combined with the business, and capital. So let me start from the bottom to the top. Capital, any business, regardless of the size, if they have any capital that is free and clear, that has some value compared to a business that has no capital. For example, I'm a wholesaler and I have a merchandise that I'm selling at a swap. And the merchandise that I have, if it's free and clear, even though I might have only $5,000 worth of merchandise, that inventory, as long as it's paying full, that's my capital, that business has some value compared to a business that has no assets or no capital. So if you have a business with any level of capital, that per se provides a value to the application and enhance the credit worthiness. So it makes the business more subject to credit because you have some assets or some capital that you're working with. The second one is management experience. Management experience is most of the time is tied to the existence of the business. So, for example, Jose might claim, I've been on as a consultant for 10 years, and now I'm going to open my private consultant firm. Probably I might be able to claim that my prior experience might help me to succeed with my business. That's one option. But a better option will be, what if I already have an existing business as a consultant that has been in business at least 1 year or 2 years? That shows that projects more credibility. The fact that I already have an existing business, at least for 1 year, 2 years, compared to a new business that I'm planning to start, even though I might already have experience somewhere else. And then finally, credit score. Credit scores today here in SoCal, between Los Angeles and Orange County, we have over 130 different active lenders, different banks. And out of those 130 lenders, I would say that less than 30, they're focusing on credit scores. Everybody, at least 100 banks, will not be looking at the credit score of the applicant. What they're looking at is that the credit report shows that everything is correct, that there is no delinquencies, and if there is delinquency, was not recent. So anybody that has any problems that is more than 6 months ago, or late payments, or 12 months, there is always an opportunity to obtain financing. So the bottom line with the credit score is, as long as you have the credit report shows that the applicant is someone that is current with the credit, that has a prudent management of it, and if there is any delinquency, a major delinquency that is remote on time, there is always an opportunity to process or to apply for financing. And if anybody has an issue before applying, the recommendation is try to obtain a copy of your credit report. And if there is any deficiencies, you must address them. For example, I have applicants in the past that they have issues with IRS tax payments, tax due payments. And what they do is that they contact IRS, they get into a payment plan, and even though the taxes are not paid, at least having a payment plan converts the delinquency into an active debt. So now they're eligible because they're not past due anymore. Now they have a new loan. There are collections out there that we might disagree, but the recommendation is try to correct any deficiencies on your credit report before you approach the lender. So anyway, in general, those three aspects, they define what if the business or the applicant is an entity or individual that is subject to credit. And then capacity to repay is basically driven by two aspects. One of them is the capacity to repay, or historical repayment capacity. This basically is the income tax. If the business is already in business at least 1 year, then the business applicant will be able to present the business income tax for at least 1 year, showing revenues, expenses, and what the net income is. And the second driver for repayment is collateral. So if the applicant has any assets to pledge to protect the repayment of the loan in case of default. So let me make an example. In general, just as a common sense, I'm saying that if an applicant has a credit score of 660, normally it's because they didn't have any recent delinquency, and they're current with all the debt, and they're not overextended with the existing credit lines. If that is the condition of the credit report, most likely the credit score should be 660 or higher. And then if somebody has a business that is in business 2 years, when we said 2 years, is also common sense. The reason is, if Jose starts a business today, I might change my mind 6 months from now. I might find a better opportunity, or I may realize that the business that I'm starting today is not feasible. But if I'm in the same line of business for 2 years, that the assumption is that I will continue in the same line of business for the future, because I already overcome the initial obstacle. So again, this is just common sense. When you approach someone, anybody, and says, I've been on the same business for 2 years, that shows that you already have some level of experience, and most likely you will continue the same line of business. So that's why when we're talking about financing or trying to identify if the business is subject to credit, the fact that it's already an existing business provides more credibility to the application. And then capital. Capital, again, is also common sense. For example, if I have a car that I owe 95% of the car, and I lost my job tomorrow, most likely I will have to give up on the car, because if I don't have an income or have problems trying to obtain income, it's going to be difficult for me to keep up with the payments, even though I don't own the car. On the other hand, if I have a car that I owe 50% of it, and I owe 50% of the car is already mine, by common sense, I will do whatever I can to keep my asset or my auto. It's not because I'm really driven by the fact that I have a debt. It's because I already have ownership on it. Another simple example of it is back in 2009, 2010, 2011, a lot of the properties, they have experienced a drop in value. So many families, they have to walk away from their primary residences because they have no capital in them. They have no equity. So sometimes it didn't make sense to keep making payments on a mortgage that was larger than the asset that you have. So the point is, if you have a business that you always maintain some level of capital, or it's not over leveraged, so you don't have a lot of debt against it, that's a positive aspect of the application. Now, on this, in my presentation, when we receive an application for a business loan, any application, we can classify them in 4 different categories: A, B, C, and D. And these categories, once the application is identified as one that is subject to credit, someone that is eligible to obtain $1,000 or $5 million, being subject to credit has nothing to do with the loan amount. It is just the character of the applicant or the business. The next step, once we identify that they have the creditworthiness, then we look into whether can the applicant is able to repay the loan. And on this case, out of the 4 options, let's say, let me go quick here. Category D is someone that when they present their application for financing, they show that they don't have repayment ability, and they have no collateral. Normally, this is the typical situation for most business startups or businesses that have been in business for a while, but based on their income taxes, they don't show that they're profitable. So that is a condition that is, that for the most part is for the startups. The opposite of it is category A. Somebody that walks into a lender and say, here is my income taxes, and I have sufficient net income, and also I have collateral to pledge. Those are what we call category A. Obviously, in lending, that is the most desirable conditions for us to provide financing, somebody that is category A. The other two options of using those items that we use to consider the repayment of the loan. Category C is someone that approaches the lender and says, I don't have income, or I don't have income taxes. I'm starting a business, but I have collateral to pledge. Probably I might even have a house that is free and clear that I can pledge for the loan that I'm applying for. This condition C, it's not very desirable for many lenders. And the reason is, even if I make a loan today and I have a house that is free and clear, that is protecting the loan, and the loan is in default because I'm not getting payment, I cannot take any legal action against the collateral unless the loan is past due 91 days. So any asset that I might be able to take, I cannot legally take any legal action normally for at least 91 days. So that is not I have to have a portfolio loans that are in default just to initiate the collection. And then it might take another 6, 9, or probably a year for us to be able to obtain some compensation out of that, so liquidating those assets to mitigate the problem with the loan. So the other category is category B. It's someone that the applicant shows that they have a capacity to repay the loan. They have income. They show that, I've been in business 1 year and I have a net income coming out of my current activities, but I have no collateral. What we do in lending is this category B. We use a loan program that is called SBA. And by using the SBA, we convert the applicant category B into a category A. It's somebody that has repayment ability, has the ability to repay the loan today, and the lack of collateral will be compensated by the guarantee that we obtain from the SBA. Basically, the SBA is kind of an insurance agency for lenders. So when somebody applies for a loan, the SBA provides a guarantee to the bank on behalf of the applicant. And basically, the guarantee says that if the business defaults the loan, the SBA will pay the bank up to 85% of the uncollected balance. So when the bank processes an application and they get the SBA guarantee, most likely that helps the lender to mitigate any potential risk in case that something catastrophic happens with the business. And then on the other hand, at the time of the application, a loan that is category B, it can be in a way be considered as a category A. The reason I like to make this presentation and spend time talking about this is because anybody that starts a business today, if they have a very simple but effective accounting or record keeping system in their business, and they get the business license, open a business bank account, and they manage all their income and expenses to that business account, if they have a successful business in 1 year or in less than a year, they will be able to be somebody that we classify as category B. If today you start your business, probably you category B in less than a year, by February 2019, if you have a successful activity, you will be, you can put yourself in a position of maybe to become a category B. I learned this through my work experience, seeing successful entrepreneurs. One example that came to my mind was this lady entrepreneur. She wanted to buy the beauty salon. The beauty salon was for sale. She needed like $30,000 to purchase this business, and she had no income. So when we look at the application, basically she was category D. She got no income and no collateral. So what she did is, because she was a licensed cosmetologist, she applied for the business license and got the fictitious and had her business bank account. and she rented a chair on one of the existing beauty salon. And working part-time, she was making about $1,000 a month between tips and commissions, but she documented that income. Even though it was all mostly cash, she was, again, recording the income that she was earning through the business bank account. At the end of the year, she reported on her business income tax that she collected almost $1,000 through the year. And with that income tax and the income that she proved that she was earning on that chair, she was able to obtain, we were able to help her to obtain the $30,000 in less than 5 weeks. Because she was already an existing business that was expanding from a chair to a full-fledged beauty salon. And this model, I'm seeing it over and over and over again. It is very difficult to envision a full business and a business in a full operation and obtain financing for it right from the beginning. Most businesses, they start building their business in little blocks based on their current capacities, and they lay out their opportunities, and then they work through the following months or years building up those opportunities. Another example, relatively recent, this individual and another entrepreneur, he had a lot of experience on the food industry, food manufacturing. And in 2011, he had the desire to open the business by himself without partners. It had limited capital, but the project was a project for about $500,000 total project cost to have the equipment, manufacturing, the inventory, and so on. So what he did is, in 2011, he put the business plan, the projection. He pulled $40,000 out of his 401k plan. With that $40,000 initial investment, he got license, packaging, permits, health department, everything ready to start. Once he got all the license in place, he secured a small business loan with one of the nonprofits for about $70,000. So at that time, he's applying and saying, I have $40,000 already put into my initial investment, and the $70,000 is just to buy inventory and have a third party do the food manufacturing. So that's 2012. And between 2012 and 2015, he built his sales. He started doing sales and getting the orders manufactured by third parties, and they start building up the business. 2015, just by using the income taxes on the prior 2 years, we were able to provide him with almost $380,000 financing to purchase equipment and to relocate the business into a full warehouse. So the bottom line is he started in 2011 with the desire to have a large business, but he only had $40,000 and a lot of desires. So what he did, he put the business plan in place. He secured his licenses. He started the business at low scale with sales, building sales. And once he built the business to a certain level, then he jumped to the next level, which was getting equipment and really fully developing his operation. He wished he had done it much earlier, but again, the limitation was capital. The only cash that he had at the beginning was $40,000 in experience. So again, myself, I've been doing business financing for many years, and it's hard to find someone that is qualified for financing today. So for the most time, most customers, clients that I come across, we discussed about the current opportunities, the future business opportunities, and then they define a small plan on how to achieve those. And if it's not doable today, it will be doable February 2019 or so, maybe a little bit later than that. But it's doable. But the fact is that they start working on it today. So again, my big picture recommendation is that it's not a secret. Is you establish your goals today. You really make a commitment for your future opportunity, and then you start working towards it based on your current conditions. And for that, you always have the SBDC, people like Manal, that they provide you with professional coaching, so they can really help you to fine-tune your idea. I mean, normally you will know what to do, but people at the SBDC will help you on how to do it. That's the best way for me to describe the sport.
Jose,
here,
Jose, hold on before you proceed. We received the question from Hani because he's saying that the sound quality is very shaky on his end, and he wanted to get clarification on what kind of credit score were you talking about, personal or business?
It's always the credit that any lender is looking at is the personal business. It's not the company. Now, if the company is large enough, I mean, I'm saying somebody that is in business 2-3 years, and they have the substantial size activity, sometimes that activity will be reported in a different credit bureau that is called Dun & Bradstreet. So the reality is that the lenders, they go into those business credit reports looking for any weaknesses, not for strength. Normally, the driver to consider the credit worthiness will be anybody that owns 20% or more of the business. The credit report will be the one that is going to rule. And there is some misinformation out there on the street to saying open your corporation and you can get credit under the corporation only. It is true when you obtaining commercial credit, I mean, from one business to another business. But when you're looking for business financing from lenders, it's always going to be the individual credit report that is going to rule. All right?
Thank you very much.
Welcome. So again, just to summarize, if anybody open a business today legally, and then they experience a business activity for the next 9 months, and that activity is profitable, even though you might not make a lot of money. Like this lady that had the beauty salon, she was making only $1,000 a month. That's not enough to cover living expenses, but having that just as a separate business activity, that was profitable by itself. And that profit that she had justified providing financing for the next level, which was buying the beauty salon. So the reason a lot of people that I met in the past that have not succeeded on this is because they don't have the proper record keeping. So when at the end of the year they have to prepare income taxes and they're not prepared for it, the tax preparer normally advise clients to put as much legal expenses as possible into the report with the intent to reduce tax liabilities. In lending, the underwriter who has no business experience, who has no industry experience, when he looks at an income tax that shows no profits, then he takes that on the face value. So normally, if you go to the accounting industry, the accountants, the academics, the regulations, basically, the basic accounting rule says that the revenues, the expenses of anything must be related to the revenue that is. In other words, if you make $1,000, you should only recognize the expenses that are related to the $1,000. I have a client who is a contractor. I look at the income tax and he shows $100,000 of revenue, but $80,000 worth of automobile expenses. When I ask him, what is that $80,000? And they explain, well, every time that I go out there and try to provide my prospect client with estimate all the driving, it's eligible for the mileage deduction. Yeah, but in order to make $100,000, you only need to spend $10,000 the most in transportation, not $80,000. So the reality is he made only $10,000 in expenses. he make a profit of $70,000, and then he used the $70,000 profit to be driving around Los Angeles. Probably might be legally, maybe illegal to do, but it's not business wise. It's not business savvy. So those are the decisions that have to be made. But most businesses, big business, they only claim expenses that are directly related to the revenue that they claim at the time. So that's something that you have to, some of the conversation that you might have with the people at the SBDC that they can provide you further guidance. We're not a tax preparers, but again, the tax preparation is an activity that has a lot of impact on a lot of small businesses and should be done right. So anyway, so if you already start a business, a year later, you might be able to convert your activity from B to B. And being B, the yes, also, and final consideration on this is the loan amount. If you apply for, let's say, $10,000, probably you're going to be a B applicant. But if you apply for $20,000, just because you apply for more money than you can afford, your application goes from B to D. So you have to be meaningful that whatever income you have is able to support the debt that you will try to apply. That way you will stay always on the B column. Then finally, if you decided to obtain financing right now to start the business, regardless of, it is possible. In reality, it's very challenging. It's very difficult to provide financing for startups. And the reason is a lot of businesses that open today, in less than 30 or 35% will be in existence 3 years from now. And there are many reasons. People that start the business today, 6 months later, they change their mind. It's not what they would thought, or different opportunities came across. So it's not always, there is no certainty that whatever I start today is going to be there for the next 2, 3, 4 years. So when somebody is looking at a proposal for a startup, it's always this they're very concerned whether this will be something that will be there next year. Personally, I'm managing the loan program at the bank. We do small loans, $5,000, $10,000, $15,000. And some of the businesses that we funded 2 years ago, they're no longer there. They were in business 2 years ago, and they decided, I had a better opportunity to make more money somewhere else, and they stopped. Those loans that we made, they still performing. They're making payments. Some of them will pay off. But the experience has been that even though they have a good project at the time of the application, later on they found a better opportunity that make them change or to reconsider their goals and their opportunities. So again, when looking at an application for the startups, it's very hard, because the question is this going to be for the next years in existence? But anyway, setting aside that concern, normally what you have to do is you have to put together a business plan. And in the business plan, you will lay out in detail all the monies that are needed to open the business and have the business up and running. So we call that project cost. So on here, I have a table with the 3 columns with numbers. The first column of numbers is called project. With project, we identify all the monies that are needed to open this business. And we have some categories here: working capital, startup expenses, furniture, leasehold improvements, and equipment. Let's say the total project cost is $100,000. And under the SBA program, that's the program that we use to finance startups. The applicant must contribute with at least 30% of the total project cost. So if we have a business proposal that will require $100,000, I have to put out of my pocket $30,000 on it, and I can borrow up to $70,000. The assumptions from the SBA is that if I said, okay, here is my $30,000, the SBA will assume that I borrow the money, and I have to prove otherwise. I have to prove the source of those funds, and cannot be from borrower sources. It has to be my own capital, and then I can apply for up to $70,000. One consideration is, let's say that I have $30,000 to inject in my business. Instead of borrowing 70, if I borrow only 30, so I put 30 and I borrow 30 for a total project of 60,000, the chances to be approved are much higher because I'm putting more compared to what I'm borrowing. So the maximum that you can borrow 70%, the least amount of money that you borrow, the better off you're going to be in case of a startup financing. So in this case, what we call debt to equity is the main driver. If you have more money putting in compared to the money that you're borrowing, you're going to be better off trying to obtain financing. I always like to share an example on this. I remember I was a consultant at the SBDC years ago, and a lady came and walked into the office and says, Jose, there is an article in the newspaper that SBA is helping women to open a business. I'm a woman, you're the SBA, here's helping. I need your help. She was a registered nurse, perfect credit, a lot of experience. And I asked how much money you need, and she said, well, I need $400,000. I'm planning to open a daycare center. And I'm not an adult daycare. Okay? And how much money you have? And she says, nothing. Okay? So we discussed about the project equity and the loan. She needed to have at least $100,000, and she walks out of the office. She came back almost 3 months later with a checking account and $100,000 on it. And we talked, and what she did is she completed a comprehensive business plan. She went out there and talked to a doctor, and the doctor agreed to be her partner. He came in with $100,000 cash because it had to be documented that he was not borrowing. So he was a partner on the business. And because the doctor was only 15% owner, the doctor was not responsible for the debt. Normally in the loan application, anybody that owns less than 20%, sometimes or most of the time will not be required to guarantee the loan. It's not a rule, but for the most part, only people that is 80% or more, they must guarantee the loan. If you're less than 20, you may not be required. So in that case, the doctor partnered with her. The doctor contributed with the equity injection, and they were able to obtain the financing because the applicant had perfect the other elements for the credit worthiness were there. So it is possible to do finance for startups, but again, it's a little bit of hard work, and the success is not always there. Again, here on the screen, I always refer to the business income tax. Like I said earlier, the underwriters, they do not have any experience with business or industry. What they do is that they look at this particular document, and if this document shows that the business reports net income, and then the lender confirms that the information provided is the one that is reported to the IRS, then the underwriter believes, okay, this is true. So if we have an activity that is profitable based on line 31, net income, then if the loan amount that you're applying for can be covered by that, then the chances to obtain financing are almost 100%, assuming that the applicant is creditworthy. But again, what I'm seeing, there is a lot of deficiencies on the preparation of income tax reports. Some of the clients that have been in business, they don't have a proper record keeping. And then those income tax reports do not show the true potential of the business. So that's something that you have to consider when you're doing your business. And it's one of the main asset that you will have to grow financially is based on this report. Also, this example that we have here, for example, we have a budget for 6 months on PISA. So what we do here is we project expenses for the following 6 months, and then you project your revenue. I mean, the purpose of the example is to show that every month you have according to this plan, you have a deficit, or you have more expenses than income coming in. So, for example, January, you got revenues $21,000. Your gross margin after cost of goods is $15,000, 120. Then you pay a total of $24,560 in expenses for the month. So your net income is actually negative $9,430. So if we add all the negatives, it would show that, let me see, okay, we have 30, 11, 3. In this case, we might need probably about $60,000 just to cover the expenses, the deficit on this business. So when you're making your projection, I'm trying to make it simple. The purpose of this budget is that you show what your expenses might be if you open your business or you run your business for the following 12 months, 6 months, and what you project the revenue is. If you have a deficit, you show, well, you know, my expenses are larger than my projected income. That's the way to justify or to prove that you need working capital. Sometimes I have loan applications where the applicant says, Jose, I'm opening the business or I'm expanding my business and I need $50,000 of working capital. But then when they put the projected profit and loss, they show profits from day one. So obviously the applicant doesn't show that they will really use the working capital request for the business. So normally that we won't discuss it, we simply decline the loan. In this case, if the applicant presents a projection that it continually shows losses, also the application will be turned down because it doesn't show that the business will be profitable at all. So if the projection is something like this, but in a 12-month scenario, is one of the main documents that the underwriters, they look into applicants for startups. I gotta be very honest on this statement. When you apply for the startup financing, all application must include the business plan. But I don't know an underwriter that will read the business plan from page 1 to the last page. So what they do is they get the business plan, they go straight to the projection, which is this page. And then when they start looking at the projection, they see $14,550 for expenses, salaries, and wages expense. Then what they do is that they go into the part of the business plan that talks about salaries, and they will look for an explanation inside the business plan as to why this applicant is planning to spend $14,000 on salaries and wages. So the business plan is critical, but it should be one that really, really explains all the numbers that you have in your projection. But again, I can expand myself a lot into this topic. Again, the best resource is going back to the SBDC with your individual project and have them help you to fine tune the projections, and then with that you can complete your business plan in case that you really want to go on startup or you want to aggressively expand your business to the next level. That you will have to have projections to explain how you're going to be able to repay the loan. Then finally, we have for anybody that has been in business at least 1 year, we have a loan program at the bank that we can provide them with up to, if you're in business less than 2 years, it's $10,000, but more than 2 years, we can provide you up to $25,000. And it's an SBA loan, very, very competitive terms, low interest rate for unsecured financing. I just want to, I'm not going to go into details on this, but I just want to make you aware that we have these resources. And when you go to a bank, you will see that they have different loan programs. That's not really important to you as a business owner. What you need to have is an application that shows that you have the ability to repay the amount of money that you're applying for. And for that, again, I will refer you back to the SBDC. Before you approach a lender, talk to the SBDC consultant. With them, you can fine-tune your application, and then then you can proceed approaching the lender. And that's pretty much what I have to say on my end. Manal, is there any question?
Yes. Thank you, Jose. Thank you so much for your time. So we have a couple of questions that were messaged directly to me. One of them is regarding collateral. The question is, if your collateral is a house and your home went through the Keep Your Home California program, which puts a junior lien on your home for 5 years, does that affect your ability to qualify for business loans or LOC?
No. If I'm having on the screen the table moving from D to B. The desirable application is one that has the applicant show that they have repayment ability, even though they have no collateral. So to answer your question is, under these loan programs, we look for collateral. But if the applicant has no collateral, the loan is not going to be declined for the lack of collateral. And if anybody has a house, if they go through an SBA loan, the SBA is going to put a lien against the home. And just for general information, even if the business defaults and the applicant, the business gets into a catastrophic situation that they cannot repay the loan, the SBA will not foreclose the house. So I have business owners that they opened a business years ago, and they were able to stay on the house. They cannot sell it, but at least they can stay on it.
Okay, great. Another question, Jose, is what would you say is the reason that small business owners are unable to obtain capital to grow their business?
The number one is they're not really prepared to show that they're subject to credit. Many applicants, they came to us assuming that the credit report is something that they cannot manage. It's something that is out there and it's out of their control. It's not true. For the most part, a lot of the deficiencies that we see is in the credit report are very minor. Maybe a collection for that $100 that was there a long time ago, or somebody that has a credit card with a small balance, but it's maxed out. Those little things impact your credit reflects on your credit report. And the second one is that the loan amount that they're applying for seems to be too high for their current level of income that they have. So it's the lack of preparation. If they don't prepare their application well, and when I say preparing well, it's identifying that the loan amount that they're looking for is something that they can qualify for. That's one of the first reasons why they're not successful. But the lender will not tell them, if you're applying for 100, I want to approve you for 100, but we can give you $62,000. That's not going to happen. Lender will say yes or not to the request only.
Thank you, Jose. One more question. The question is, so business owners with bad credit and no sales cannot obtain a loan or cannot get a loan?
With bad credit?
Bad credit and no sales. I guess, what are their chances to obtain a loan or be approved for a loan?
If somebody has bad credit, it's because they cannot manage the credit that they already have. And if you get more credit, the life is going to be more miserable. It is also unlikely that you can, if you already have a credit relationship in trouble, that you're going to get somebody else to give you money to pay that one and now be in trouble with the new one. So if you have an issue with credit, the most desirable thing is to go back to your current creditors and get an arrangement. So it's impossible. It makes no sense to provide financing to someone that already have a credit issue right now. My very personal experience with few people is if the person already have problems and the new debt doesn't get them out of the trouble, now he got a bigger problem after that, because now he got a new debt on top of the old one. And then the lack of sales, it's very challenging. Even if you provide, everybody's well intended, and if the projection don't happen, everybody's going to be in trouble, including the applicant. So that's why I make emphasis. If you can start your business today and generate some sales, then you borrow against your current ability.
So to build on that last question, Jose, we just received another question. What is the best way to build credit in your business if you cannot obtain a bank loan?
I will start with, there is a way, through the SBDC, you can register your company with Dun & Bradstreet for free. Then try to obtain credit with another business that might be able to report you to Dun & Bradstreet. And then also at the personal level, try to obtain secure credit. $300 to the banks out there that you make a deposit, $300-500, and you can get a credit card against your deposit. You have to start building credit. And what is the beauty of it is very easy to obtain financing. To build credit if you use a savings account.
Yeah, and I agree with that, Jose. I know through my experience with the SBDC, I can tell you one of my clients located to the United States about 5 or 6 years ago, and she's been handling all her finances as cash transactions, no credit card, no check, and literally because of that, her personal credit score suffered. So right now she's ready to open and expand her business, a new business, and for that reason, her credit score is very low, which is kind of standing in her way of obtaining a loan.
Yeah. Now the credit report it's also an asset, both personal and business. And if you put attention to it, every credit report is different. So when I got my own credit report, it will not change. In 6 months from now, most likely it's going to be the same. But there are certain things that I can do to protect or to improve my credit report in the next 6 months. So my recommendation, everybody should get to copy your credit report, look into it. And then you will see that it's using common sense. There are certain things that you can do to improve it. It's not that hard.
Yeah, that's true. And for those of you who don't have a free access to your credit report through your credit card statement, because I know some credit cards do offer that service for free, you can actually obtain your own at no cost to you through creditkarma.com. It's once a year. You can obtain it at no cost to you. You can get a copy just to get a sense of where you stand at a personal level in terms of your credit score. So that would be it for us today. Thank you so much for joining us, and thank you for all the questions. If you feel that you could use some of our assistance at no cost to you whatsoever, please feel free to give us a call at 714-564-5200 to schedule a private, no-cost, one-on-one consultation. Also, please expect an email with the survey link after this workshop. Please give us your feedback and let us know what you think. And we will also be sharing with you a link to the recording that includes the voice and the visual for this presentation. Thank you so much, Jose, for your time. It's been a pleasure working with you, and I so appreciate you taking the time to put together this presentation and share your valuable knowledge with all of our attendees. We're gonna wrap up the meeting right now. If you have any additional questions or you need to talk to us, please give us a call, 714-564-5200. Thank you.
Thank you. Thank you very much, everybody.
Thank you.
Have a good day.